Hi, and welcome to this week's market presentation. Latest news. Progress towards an end to the war in Ukraine appear to make progress with the US, Ukraine, and Russia negotiating a new peace agreement. The latest peace framework built upon the controversial US-Russian proposal, which included significant concessions from the Ukrainian side with limited ones from Russia. Most notably, it would include ceding Ukrainian territory that is not under Russian control, halving its military, and renouncing NATO membership. President Zelensky from Ukraine has vowed that he's open to working from that proposal towards one that can be agreed by both sides, with progress appearing to be made on that front. Nonetheless, any changes to the peace proposal that was reported on might become untenable from Russia, and so it remains unclear whether a final end to the war will be able to be agreed upon. In the meantime, hostilities continue in Ukraine with significant attacks from both sides against each other's energy infrastructure, as it now takes a more frontal role in terms of targets. Impacts on energy markets was a little more subdued due to the continued uncertainty, but nonetheless felt. It contributed to oil's downward trend, as it could mean an end to the ongoing attacks against Russia's oil refineries and export facilities. Additionally, a peace deal could threaten the end or the removal of sanctions in what is already a well-supplied market, both in terms of crude oil and global LNG, further adding to bearish sentiment if it were to happen. Overall, we saw a general positive impact and response from global equities, but negative for oil as a commodity. Nonetheless, even if a deal is reached in the short term, an immediate shift in supply would certainly be unlikely and would still require some time. In other news, Saudi Prince Mohammed bin Salman visited the White House this past week with significant announcements, particularly in terms of the closer relationship between Saudi Arabia and the US, with the Saudi prince announcing plans to increase its investment commitment to the US from 600 billion to 1 trillion US dollars. At the same time, deals were announced that were focused heavily on AI, critical rare earth minerals, advanced technology, and the defense industry, with the US agreeing to sell its most advanced fighter jet, the F-35, to Saudi Arabia. The impact on markets was rather subdued. The immediate impact on oil prices was limited, since it seemed more influenced by broader market conditions than any promise or announcement made during the visit to the US. Despite little details, however, heavy announced investments into additional LNG infrastructure could have a bearish impact in the medium to long term, as it contributes to the rapid scale out of LNG export and import capacity globally. Lastly, the meeting did present a bit of a two-edged sword, since economic sentiment boost is met with uncertainty regarding the situations in the Middle East. And then lastly, the COP30 global meeting got concluded with some of the key takeaways being less aggressive and optimistic than some had anticipated. The latest draft proposals dropped the earlier roadmap and now only noted an, quote, irreversible shift to low emission development with no real fossil fuel transition plan. Additionally, the outcome was heavily dependent on voluntary actions, with the final text urging countries to only voluntarily reduce fossil fuels without setting more aggressive and impactful measures to reduce fossil fuels. NGOs and the European Union were certainly disappointed with the lack of progress and the lack of ambition and cohesion in the final agreement. Nonetheless, we still saw significant financial commitments, with financial pledges increasing to mobilize $1.3 trillion per year by 2035 for climate action. The impact on markets was to sow additional uncertainty onto the energy transition, especially the pace and scope of the movement towards renewables and away from fossil fuels. This was certainly positive news for the fossil fuel industry, which will likely feel less pressure on its industry from global countries. Weather. Onto the weather front, temperatures across most of Europe are still forecasted to remain below the seasonal average throughout the beginning and middle of this week, before trending slightly warmer, particularly in Central Europe. Overall, as we move deeper into the winter, we are seeing a notable trend towards colder weather, increasing overall heating consumption. In terms of precipitation, more limited precipitation across much of Europe, especially once we get through the beginning of this weekend into early next week, although the Nordic region is still expected to see more precipitation early next week. And lastly, in terms of average wind speeds, we are seeing relatively limited wind speeds over the course of the next 4 to 6 days, with a slight increase there, particularly in the North Sea and northern parts of Germany at the beginning of next week. Microeconomics. New GDP figures were released for the third quarter of this year for the Euro area, Japan, and the UK. The Euro area GDP growth was relatively limited at just 0.2%, an increase of 0.1% quarter over quarter. Overall, year-over-year growth came out at 1.4% for the last quarter. The situation, however, was worse when looking at Japan and the UK, which saw more noticeable decreases in GDP growth over the past quarter, with quarter-over-quarter growth at nearly negative at 0.4% in Japan, and with limited growth in the UK at just 0.1%. Nonetheless, those were worse outcomes than the previous quarter. In terms of inflation, we've seen a decrease in inflation across the Euro area, Japan, and the UK. For the Euro area in particular, we are seeing inflation remaining steady at just above the 2% target set by the European Central Bank, with core inflation slightly higher but still stable at 2.4%. Crude oil and LPG. Global crude oil markets saw further decreases over the past week, with WTI moving firmly below the $60 per barrel price level, and Brent crude oil prices now approaching the $60 per barrel price level. Overall, crude oil markets remain bearish on the back of an oversupplied expectations for the coming year. Fundamentals remain largely unchanged week over week, with now OPEC confirming a Q3 25 market surplus of 500,000 barrels per day, reversing their previous expectations of a deficit of 400,000 barrels per day. Lastly, weighing on markets globally are the more than 1 billion barrels of crude oil still floating at sea, 40% of which coming from sanctioned nations. Natural gas. Looking at natural gas prices, we saw a further decrease over the past week, with the frontier decreasing by nearly 4% week over week in what has become a more clear bearish price evolution for natural gas prices in Europe. Storage levels have decreased over the past week as the withdrawal rate moved further into negative territory, as you can see here, moving closer to the withdrawal rates that we saw last year, which were the highest since at least 2012. Nonetheless, the storage deficit versus the previous year has narrowed from around 12% to 9.5% as of the end of last week, which has become a bit of a bearish signal in the market, as the deficit reduction has helped improve the security of supply expectations for the coming months. Looking at the total supply and demand situation, total demand has increased quite aggressively over the last couple of weeks, very much on the back of the colder weather across Europe, increasing total gas consumption. On the supply side of things, we've seen an uptick in total supply, although not as sharp as that of demand. Overall, total supply remains on the lower end of the past 5-year average. Looking at the supply mix, we note a slight decrease in Norwegian gas flows to Europe as a result of some needed maintenance. in the Norwegian gas infrastructure, while on the other hand, LNG sendouts have continued to compensate for the drop in Norwegian gas flows and also the increase in total gas consumption. Overall, LNG imports in Europe have surged to 8-month highs on the back of strong US deliveries. Price competition for LNG also remains subdued with Asian consumers, in part because of Chinese decision to purchase LNG from Russia's sanctioned Arctic 2 LNG terminal, with Chinese buyers able to secure 30 to 40% discounts on sanctioned Russian LNG. The market sentiment amongst investment funds continues to be more on the bearish side as we see the level of net positions move closer towards net short positions. Overall, we have seen both long and short positions increase over the last few weeks in the market, with short positions increasing at a slightly faster pace. Coal. Looking at coal prices, we see a slight decrease over the past week in coal prices globally in what has remained a more neutral price evolution near the bottom of the range of prices as we've seen over the last few years. In Asia, we did see Chinese thermal coal imports in November rise to 31 million tons, the highest since December 2024, due to some greater consumption, but also the decrease in domestic production. In Europe, recent cold weather has certainly increased demand from the power sector. However, given the short nature of the colder weather, we are not seeing such support lend itself to a more sustained increase in coal prices, but yet to be seen if weather conditions, how they will fare moving forward. Overall, on the bearish side of things, the lower gas costs and the higher price for carbon allowances is certainly limiting coal-fired power generation, leading to more coal to gas switching, keeping downward pressure on prices. EU and UK emission allowances. In terms of carbon allowances, we continue to see a more bullish price evolution in the European spot market, while the UK both spot and forward markets are seeing a more clear bullish price evolution overall. Emission allowances, we continue to see the tighter expectations in the market for 2026 add upward pressure to markets, and on the UK side, certainly the progress made towards relinking the EU and UK carbon markets. In terms of carbon emissions, the colder weather is increasing overall power sector emissions as we see the output from fossil fuels increasing over the past week, adding further support to coal carbon prices in Europe. Investment fund sentiment remains on the bullish side of things, with the level of net long positions reaching a new record high in Europe, over 102 million tons. Over in the UK side of things, we continue to see net long positions near record highs. Electricity. Moving on to electricity prices here, we note the different price evolution that we see with natural gas. Electricity prices in Germany and in other markets across Europe are seeing a more bullish price evolution over the past few weeks, although prices over the past week have seen limited movement up or down. Looking at other electricity markets in Europe, we see a similar trend, particularly looking at the price evolution in Poland there. A couple exceptions are certainly the decrease in electricity prices seen in the UK market and particularly the French market. On the French side of things, very much benefiting from the improved nuclear output, easing the tightness in the market. Then over in the Nordic region, we see a little more stable price evolution. However, we do see that drop in prices over the past week, in part due to the wetter weather forecast improving the hydrological balance and as a result, hydropower outlook in the region. Moving to the fundamentals, we see total grid demand pushing up close to the levels we saw last year, near the top of the range for this time of year over the past 5 years. Residual load has similarly been increasing as the increase in renewables is not sufficient to meet the increases in total demand. Moving on to the supply mix, here we note the continued improvements in nuclear generation out of France, now moving to the highest levels over the past 5 years for this time of year. Renewable power generation has also been increasing over the past week, although much more modestly and notably below the levels we saw last year. Given the increases in total demand for electricity, fossil fuel power generation has had to increase as well, moving up closer to the past 5-year average. The somewhat disappointing renewable power output for the past week was largely due to the weaker wind power generation, as wind speeds were not as favorable over the past week. Solar and particularly hydro reservoir generation has remained above the past 5-year average, helping to limit some of the downward pressure on output. In terms of fossil fuels, we see that sharp increase in fossil gas generation pushing up above last year's levels and above the past 5-year average. Coal power generation has also been increasing, although it's only been weighed down by the lower gas prices and the high carbon prices, limiting the demand for coal-fired power generation. Lastly, looking at the guarantees of origin, here we've seen an uptick in the market. On a percentual basis, we see a pretty significant increase with prices for 2025 production year increasing as high as 17.2%, 2026 pricing increasing roughly 25% over the past week. However, on an absolute basis, we do see that given the very low price for guarantees of origin, we are seeing somewhat more limited movement. Nonetheless, the rebound in the market is a change in direction compared to the more continued bearishness that we were seeing over the previous few weeks. Overall, price levels for guarantees of origin remain at very attractive levels looking historically. That covers this week's market presentation. Thank you for joining.